Very good day, my dear students. So the ICAI has now released the RTP revision test paper for the CA Intermediate Taxation paper for the January 2025 attempt, and I am giving the link to download this RTP in the description box. And in this video, I will discuss the working steps or the full solution to the MCQs. For the descriptive questions, I'm not going to do that because the solutions for those questions have already been detailed and given in this RTP itself. So you can solve the RTP and then you can cross-check your answers, including the working steps with those which are given in this RTP. But as far as MCQs are concerned, only the final answer is given, but the logic or the reasoning or the steps are not given. So many times there is a confusion, there is doubt, and clarity is required as to why a particular answer is correct or incorrect. So in this video, I will be explaining to you the working steps for the answers to the MCQs, both for income tax and GST. So I will not be going through the question because I'm presuming that you would have solved the RTP first and then you would watch this video. So I will quickly just run through the working notes for the answers to help you understand why is a particular answer to an MCQ the right one. So we first cover the case scenario for income tax and then we move to GST. So this is income tax and this is the question basically. There is this concept of LLP, and which has set up a unit and SEZ, and then there are details of the partners of the LLP and certain details in respect of Mr. Ganesh, who is one of the partners, and further details of investments made by that partner. Now we move to the first question. What is the amount of remuneration allowable as deduction to the LLP for AY 24-25 under the head PGBP? And the correct answer will be D, 24 lakh. And we will now understand how has this been arrived at. Now the details that are given is Sagar LLP has three partners, Mr. Ram, Mr. Shyam and Mr. Ganesh. Now Ram and Shyam are working partners while Ganesh is a non-working partner. All the three partners are receiving remuneration of 1 lakh per month, which is already debited to the P&L account of the LLP. Now, the section which will be relevant here will be section 40B. Section 40B. And this allows for deduction of remuneration to working partners. That means interest to the remuneration to a non-working partner, that is a sleeping partner, is not allowed as a deduction. And deduction of remuneration to working partners is allowed up to a certain limit, which is provided by section 40B. And on first 3 lakh of book profit, it is higher of rupees 1.5 lakh or 90% of book profit, and on the balance of book profit, it is 60%. And this is the overall limit for payment of remuneration to all the partners, working partners, during the previous year. Okay. And the remuneration is allowed as a deduction to the firm to this extent. Now, as we know, the tax treatment of firm applies to LLP as well. So this 40B applies to LLP as well. So when we talk about LLP, 40B applies to the LLP as well. And when we compute the book profit is basically the net profit as per the P&L computed as per PGB provisions, and to that we add the aggregate amount of remuneration. So if the remuneration has been deducted to arrive at the profit, we add it back. So book profit is basically net profit without providing for remuneration. Now if we go to our question, the remuneration has already been debited to the P&L. That means 1 lakh per month for one partner, 12 lakh for one partner, for three partners 36 lakh. So 36 lakh has already been debited, and the profit is given in this table. So profits of units located in SEZ, and we can assume that 58 lakh which is given here is the profit as computed under the head PGBP, right, the business profit of the LLP. So 58 lakh, and since the remuneration has already been debited, we add this 36 lakh and 94 lakh is what we get as the book profit. And using this book profit, we determine the limit of deduction for remuneration under section 40B. So on first 3 lakh of book profit, as we saw, what was the limit? 1.5 lakh or 90%, and on the balance of book profit 60%. So when we use this particular formula, so it is 1.5 lakh or 90% of book profit. So on first 3 lakh it comes to 2.7 lakh, and on the balance of book profit, that means 94 lakh minus 2.7 lakh. On that balance, when we apply 60%, it comes to 54.6. So total is 57.3 lakh is the limit of remuneration which is allowable as deduction in the hands of the LLP by virtue of section 40B. Now Mr. Ganesh is a non-working partner, so the remuneration of 12 lakh paid to Mr. Ganesh will not be allowed as deduction. Okay. Rest for Mr. Ram and Mr. Shyam, 12 into 2, 24 lakh will be allowed as the deduction, and 24 lakh is well within this limit. So entire 24 lakh will therefore be allowed as a deduction. Okay. Second question. What is the amount of deduction available under section 10AA to Sagar LLP and under section 35AD to Mr. Ganesh while computing income under the regular provisions of the Income Tax Act? So when we talk about regular provisions, the deduction will be allowable under section 10AA as well as under section 35AD. These deductions are not blocked under the regular provisions. And the correct answer which is given is 21.875 lakh under 10AA and 60 lakh under 35AD. And we will see how has this been arrived at. Now, Sagar LLP has set up a unit in SCZ in the financial year 2018-19 for manufacture of textiles. All conditions of 10AA have been fulfilled, and the details of unit for the 23-24 financial year is profits of the unit is 58 lakh. Export sales received in India in convertible foreign exchange on or before 30th September 2024 is 1 crore, and domestic sales is 60 lakh. Now, if we look at the provisions of 10AA, the manufacture or production should have begun during this period, 1st April 2005 to 31st March 2020, and this is being satisfied in our case. And then we are told that for the first 5 years, for the next 5 years and subsequent 5 years, this is the extent of deduction. Now, and these years begin from the year in which the unit begins manufacture, production or provision of services. So if we look at our question, 2018-19 is the first year, and therefore 2023-24 will be the 6th year. Since this is the 6th year, okay, 50% of profits derived from export will be allowed as deduction. And profit derived from export will be profits of SEZ unit into export turnover divided by total turnover, and the export turnover should be brought into India in convertible foreign exchange within 6 months from the end of the previous year, that means by 30th of September, and this is what is given on or before 30th of September. So entire export sales qualifies for the purposes of this formula. So 10AA will be profits into export turnover divided by total turnover. Now export turnover is 1 crore, and total turnover will be export turnover plus the domestic turnover, it will be 1 crore 60 lakh. Okay. Now, what will be the profit of the unit in SEZ? Now, profit is 58 lakh. And as we saw, it is mentioned in the question that remuneration of 36 lakh has been debited to P&L account. But as we arrived in the previous question that only 24 lakh are supposed to be allowed as deduction as far as remuneration is concerned. That means 12 lakh is not supposed to be allowed as deduction. So when we compute the profit of unit, when we arrive at this profit of unit, we will need to add back 12 lakh, okay, which has not been allowed as deduction in the hands of the LLP for Mr. Ganesh, because Mr. Ganesh is a non-working partner. So 12 lakh when we add it, this comes to 70 lakh. So we will need to use this 70 lakh and then arrive at the deduction under section 10AA. So 70 lakh into 100 lakh divided by 160 lakh and 50% of this, because we are running in the 6th year. So 50% of deduction will only be allowed. And this therefore comes to 21.875 lakh, which is the answer. Okay. The next portion of this question was how much deduction will be allowed to Mr. Ganesh under section 35AD. Now, when we talk about Mr. Ganesh, we see in this question that he has set up a warehousing facility in Pune for storage of agricultural produce, and this is a specified business under section 35AD. It fulfills the condition for deduction under section 35AD. Capital expenditure in respect of warehouse amounted to 90 lakh, including cost of land 30 lakh. And this was incurred during the previous year 23-24. Okay. And the warehouse became operational with effect from 1st December 2023. The profits from operation of warehousing facility before considering deduction under section 35AD during the financial year 23-24 is 1 crore 10 lakh. So deduction is allowed under section 35AD. All the conditions are being fulfilled, and warehousing facility for storage of agricultural produce is a specified business. Capital expenditure is 90 lakh, but we know that 35AD doesn't grant deduction in respect of cost of land. So we reduce 30 lakh from 90 lakh, and what remains is 60 lakh, and the 60 lakh is the capital expenditure and it was incurred during the previous year in question, and therefore the 60 lakh is the amount which should be allowed as deduction under section 35AD. Okay. So this completes the answer to the second question. Now we move to the third question, where we are asked to figure out the total income of Mr. Ganesh under regular provisions of the Act for AY 24-25. So total income of Mr. Ganesh. So we will move item by item. So first item is the remuneration which has been received by Mr. Ganesh. Now, as we noted some time back that Mr. Ganesh is a non-working partner, so the remuneration paid to Mr. Ganesh of 12 lakh is not allowed as deduction in the hands of the LLP. Now, what we know is that what is allowed to the firm as deduction is taxable in the hands of partner and vice versa. Okay. What this means is what is disallowed to the firm is not taxable in the hands of partners. Okay. So, since the deduction of remuneration is not allowed in the hands of LLP, it will not be taxable in the hands of Mr. Ganesh. So on account of remuneration, nothing will be taxable in the hands of Mr. Ganesh. Next, we see that Mr. Ganesh was employed in XYZ Limited till 30th September and having a salary of 80,000 per month. So for 6 months, we need to add the salary income, which comes to 4,80,000, and then we need to provide standard deduction of 50,000. So the salary income will come to 4,30,000. And then the details in regard to the warehousing facility are given, and the profit from operation of warehousing facility before deduction under 35AD is 1 crore 10 lakh. So profit is 1 crore 10 lakh. Okay. And since we are talking about total income under regular provisions, 35AD will be allowed. So 35AD, as we saw earlier, is 60 lakh. So 60 lakh is what we will provide as deduction. So the amount here will come to 50 lakh, which will become taxable under the head PGBP. Then we are told that he paid lump sum premium of 90,000 towards health insurance of self and wife, age 43 years, for 36 months on 1st October 2023 by account paid check. And he also contributes 1,50,000 towards PPF. So PPF 1,50,000 we know will be allowed as deduction under section 80C. And this health insurance premium will be allowed as deduction under section 80D. 80D. Now this is a multi-year premium payment. And in such case, deduction for each previous year will be the amount paid divided by the total number of previous years comprised in the period beginning with the previous year in which amount is paid and subsequent previous years during which the insurance shall be in force. So if we look at our question, The period for which insurance will remain in force is 1st October 2023 to 30th September 2026, 36 months. So how many previous years are included here? Not 3, but 4. 4 years. 23, 24, 24, 25, sorry, 23, 24, 24, 25, 25, 26, and 26, 27. So 4 previous years. So this 90,000 will be spread across 4 previous years. So for this previous year, it will be 90,000 divided by 4, 22,500. And since this is within the limit of 80D deduction of 25,000, this whole amount will be allowed. So this, if we aggregate all these amounts which we have figured out, the result will be 52,57,500. So this will be the answer. Okay. The next question is, what is the tax liability rounded off of Mr. Ganesh? What will be the tax liability rounded off of Mr. Ganesh under the default tax regime under section 115 BAC for AY 24-25? Now we are not supposed to consider the regular or the optional tax regime, but the default tax regime under section 115 BAC. So we first need to figure out the total income, and then we need to determine the tax liability. So the starting point can be 52,57,500, which is the total income under the regular provisions or the optional tax regime, and then we need to make certain adjustments to arrive at the total income under the default tax regime under section 115 BAC. So 52,57,500 we start with, and the first adjustment that we make is 60 lakh of deduction under section 35 AD that we had provided under the regular provisions, because 35 AD is blocked under 115 BAC. Under 115 BAC. See, 35 AD is basically blocked, but what we need to consider is if deduction under 35 AD is disallowed, normal depreciation on capital expenditure that would otherwise have been allowed under 35 AD should be allowed. So if we are adding back 60 lakh on account of 35 AD, we should now deduct the normal depreciation which would have been allowed to Mr. Ganesh. Now depreciation will be allowed on what? Depreciation will be allowed on the warehouse, on the warehousing facility, and it is a non-residential building. So what will be the rate of depreciation? Rate of depreciation will be 10%. Now 10% on what? Now the cost of warehouse was 60 lakh, 90 minus 30 lakh. So 10% of 60 lakh should be 6 lakh. So 6 lakh should be deducted as depreciation. But no, this is not correct. Why? Because when we talk about depreciation, we also need to take into account the duration for which the asset was put to use during the previous year in which it was acquired. And here you need to note that warehouse became operational with effect from 1st December 2023 only. That means the warehouse was first put to use on 1st December 2023, therefore put to use for less than 180 days during the previous year in which it was acquired, and therefore only half of the depreciation will be allowed. That means not 6 lakh, but only 3 lakh of depreciation will be allowed. So we will need to reduce only 3 lakh of depreciation. The other adjustments that we need to make is to add back 80C and 80D deductions, because these are blocked under 115 BAC. So when we aggregate all these, this is 1,11,30,000 comes as the total income. And when we apply the 115 BAC tax rates to this, the tax liability will come to 3,634,640 when we round it off. Now what we need to note is surcharge will be applied at the rate of 15%, because the total income, if you look at the rates of tax, this is the rate of surcharge. The total income is more than 1 crore and up to 2 crore. The rate of surcharge is 15%, and therefore 15% we apply as the rate of surcharge, and we apply 4% as the rate of cess. So the tax liability, when we round it off, will come to 3,634,640, and accordingly this will be the answer. Okay. The last MCQ is what is the tax liability, once again rounded off, of Mr. Ganesh if he has opted out of the default tax regime. So that means we need to now compute the tax liability under the regular tax regime or the optional tax regime. Now total income is what we had already determined in question number 3, which is 5257500. 5257500. Now if we compute the tax or the regular tax on this income, and for that we will need to apply the rate of surcharge as what? 10% only. Why? Because the total income is more than 15 lakh but not more than 1 crore. So if we look at the rate of surcharge, where total income is 15 lakh and up to 1 crore, the rate of surcharge becomes 10%. So in this case, 10% surcharge when we apply, and 4% cess when we apply, and when we consider total income is 5257500 and apply the regular tax rates under the optional tax regime, the regular tax will come to 1589874. This is one amount, but this is not it. This is not the answer. So 1589874, 1589870, but this is not the answer. Why? Because we need to consider AMT provisions, alternate minimum tax provisions, also into account. Why? Because Mr. Ganesh has claimed deduction under section 35AD. Under section 35AD, this is what we need to consider as well, right? Alternate minimum tax. The person has claimed deduction under section 35AD, and if the adjusted total income is more than 20 lakh and tax is not payable under default tax regime, then AMT provisions will apply. So 10AA has been claimed, and in the question only we are given that compute the tax liability under the optional tax regime. So default tax regime is out. What we need to check is whether the adjusted total income is more than 20 lakh, and for that we need to compute the adjusted total income or the ATI. Total income, we need to add deduction under section 35AD, and in that case reduce the depreciation allowable under section 32 in lieu of blocking the deduction under section 35AD, and that will bring us to ATI amount. Okay, so we compute the ATI, adjusted total income. So what is the total income? Total income is what? Under the optional tax regime, 5257500. Okay, to that we add 60 lakh, the deduction under 35AD which has been claimed, and in lieu of that we allow the normal depreciation, which is what? Which is 3 lakh, which we discussed some time back. 3 lakh. So this comes to 10957500 total income for the purpose of AMT, that means the adjusted total income. And now we compute the AMT. So what will be the AMT? The rate of AMT will be 18.5% of ATI plus surcharge and HEC. Okay. So 18.5% of this amount is 2027137.5. To this we add surcharge at 15%, not 10%, 15%. Why? Because this ATI is more than 1 crore and up to 2 crore. So the rate of surcharge, as we saw some time back, will not be 10%, it will be 15%. And we add 4% cess. So the AMT comes to 2424456. 2424456. Now since this is more than the regular tax, AMT will become payable instead of regular tax. So AMT will become payable, and when we round this off, it will come to 2424460, which will be the answer. Okay, so hope you have understood this. If you have any doubt, just write to me in the comment box, and if you have got my WhatsApp number, simply drop me a message and I will reply to you as soon as possible. Now we move to the GST part, and this is the case scenario: Vintage Cinemas Private Limited, VPCL. And the first question is, which of the following statements is correct in relation to registration requirements of VPCL in relation to operations to be commenced in the state of Gujarat? And we are told that this VPCL runs multiplexes across several states, corporate offices in Mumbai. It is registered in multiple states, and it offers movie tickets, F&B and other entertainment related services. Turnover in preceding financial year was 175 crore, and it crossed ATO of 35 crore till June in the current year. And in July, it opened a new multiplex in Gujarat. where the operations will commence from 1st of August. Now we move to the question. So if we look at certain points relating to the provisions, we see that a supplier is liable to be registered in the state or UT from where he makes a taxable supply of goods and services if his ATO in a financial year is more than the registration threshold. And when we look at VPCL, the registration, and when we look at this particular chart, then the threshold which we figure out is 20 lakh. Okay, it is 20 lakh. So once the ATO exceeds 20 lakh, registration is required. Further, we know that if the ATO exceeds the registration threshold, that means 20 lakh in the financial year, it is liable to be registered in the state UT from where it makes a taxable supply. Okay. Thus, once the ATO exceeds the registration threshold, which is computed on an all India basis, and if there are more than one state UT from where taxable supplies are made, registration is required in each of such a state or UT, regardless of individual turnover in each state or UT. So the ATO in the preceding financial year was 175 crore, and the company already is registered across multiple states. And now in the current year, the ATO has already crossed 20 lakh, that is 35 crore. And even though the ATO is zero in the case of multiplex, which is supposed to be opened in the state of Gujarat, but the fact is the ATO has exceeded the registration threshold, so registration is required for this particular multiplex now. So the correct answer will be VPCL is required to take GST registration in Gujarat while commencing business in Gujarat, as ATO of VPCL has already exceeded 20 lakh in the current financial year. A option will not be correct. VPCL is not required to take GST registration for Gujarat multiplex till turnover of Gujarat multiplex does not cross 20 lakh. This is not correct because we note that ATO is computed on an all India basis and not merely for the Gujarat multiplex. Okay. C is also not correct. VPCL is allowed to add Gujarat multiplex as additional place of business. No. Under the existing GST registration in Maharashtra, no. GST registration in Maharashtra will be separate. Gujarat is a separate state, so separate registration in Gujarat will be required. Option D is also not correct. BPCL is required to take GST registration only from the next financial year, subject to the condition that turnover of current financial year for Gujarat multiplex exceeds 20 lakh. This is clearly not the law. So the correct answer will be answer B. Okay. Next question, which of the following statements is true in relation to filing of return by BPCL? Now, filing of return. So there are a few options, and what we are told is due to operations in multiple states, the finance and accounts operations are handled by a centralized team at corporate office in Mumbai, and this team files the GST returns for all the GST registrations of the company. Okay. Now, when we talk about filing of returns, we need to note this. Every registered person is required to furnish a return in GST R3B. If so, every registered person is required to furnish the return. So what will be the correct answer? BPCL will be required to file separate GST return for each state where it is registered, because for each registration it becomes a registered person. So for each state a separate return is to be filed. So BPCL is required to file a single consolidated GST return for all states on an all India basis. Obviously this is not correct. BPCL is required to file returns only for Maharashtra where its corporate office is located. This is also not correct. And VPCL has an option to file return in the state with the highest turnover. There is no law to this effect. So option B is the correct option. Okay. Third question, BPCL is required to levy GST on rental charges. And then there are these four options. So regarding rental charges, we are told that the company is engaged in leasing of space to independent vendors in its food court against rental charges for the purpose of increasing the source of revenue. So in the food courts and the multiplexes, it has leased out the spaces to independent vendors and it charges rent from these vendors. So VPCL is required to levy GST on rental charges. And the correct answer is D, irrespective of the turnover of the tenant or the amount of rental charge collected in the hands of VPCL. Turnover of tenant or amount of rental charge is not relevant. GST is supposed to be levied and it needs to be collected on the rental charges. It is because if you look at the provisions of registration, where we are talking about a taxable person, okay, liable to be registered but not registered, registered whether liable or not. So this is the case in our hand because the various multiplexes, the VPCL is registered in multiple states. So VPCL is liable to pay tax on outward supplies. VPCL can collect tax from customers on outward supplies, that means from the vendors in respect of rent, right? And it can avail ITC also of tax paid by it on inward supplies. So GST is supposed to be levied on the rental charges, and the turnover of the tenant or the amount of rent charge is not relevant. So option A, GST is to be levied on rental charges only if turnover of tenant exceeds 20 lakh. Incorrect. Only if the turnover of tenant exceeds 1.5 crore. Incorrect. Only if total rental charge collection exceeds 20 lakh. Incorrect. So all these options are incorrect. Okay. Next question. In respect of the refundable security deposit given by BPCL, there are these four options. And regarding refundable security deposit, we are told that the company obtained a new office building in Mumbai under a rental agreement and paid an amount of 5 crore as refundable security deposit to the owner. And the term of rental agreement is 5 years. That means after 5 years, rupees 5 crore will be refunded by the owner of the premises to VPCL. Okay, so this 5 crore is not rent, it is refundable security deposit. So in respect of refundable security deposit, the correct answer will be there is no requirement to pay GST by the owner or VPCL. So GST is not supposed to be levied on this refundable security deposit. And this will become clear when we consider one of the conditions for a transaction to be treated as a supply is that supply should be made for a consideration. And when we look at the meaning of consideration, consideration includes certain things and does not include certain things, but it is given that a deposit given in respect of supply of goods or services is not considered as payment made for such supply unless the supplier applies such deposit as consideration for the said supply. So security deposit is not considered as consideration. It will be considered as consideration only when the supplier, that means the owner of the premises, applies such security deposit as consideration for the said supply. That means applies it as rent. That means when the owner treats the security deposit or a part of it as rent, only then it will be considered to that extent as supply, because that will be the part which will be treated as consideration. Now here in case of refundable security deposit, the entire security deposit is refundable and no portion of this deposit has been treated as rent, and therefore there is no requirement to pay GST. So GST is payable on deposit amount by owner? No. GST is payable by BPCL? No. GST is payable in equal proportion over the term of 5 years? No. Okay. Next. VPCL is dash for the advertisement material sent from Maharashtra office to Gujarat office in relation to the upcoming movies. And the correct option is liable to generate a tax invoice as well as an E-way bill. So E-way bill is required and tax invoice is required because advertisement material has been sent from Maharashtra office to Gujarat office. And if you look at the question says that advertisement material has been dispatched worth 35 lakh from Maharashtra to Gujarat multiplex. Okay, from Maharashtra to Gujarat multiplex. Now Maharashtra, the company is registered in the state of Maharashtra and it is registered in the state of Gujarat. So these are distinct persons. These are distinct persons. Now since these are distinct persons, tax invoice will need to be issued. Distinct persons means for the purpose of GST, it will be treated as they are separate persons. So one person is supplying goods to another person and therefore tax invoice will need to be issued. Similarly, E-way bill will also need to be issued. If you look at the provisions of E-way bill, Every registered person who causes movement of goods of consignment value more than 50,000 is required to generate E-way bill. So E-way bill is required where consignment value is more than 50,000, and here we are talking about the consignment value worth 35 lakh. So clearly E-way bill is supposed to be issued. So both tax invoice and E-way bill is required to be issued. Okay. So after this we have descriptive questions. So this is all for this video. So hope the logic, reasoning, the steps, the working notes for each of these MCQs are clear to you. If you have got any doubt, if you need to ask anything, just write to me in the comment box, or if you have my WhatsApp number. The existing users of my website www.taxwithsharad.com have my WhatsApp number. So in that case, you can simply drop me a message and I will reply to you as soon as possible. See you very soon in my next video. Good luck, goodbye, all the best to you. See you soon.